$100,000 is a big sum of money, but it's not big enough for you to change your life, and it certainly isn't enough for you to retire these days. However, today I'm going to make the argument that putting $100,000 into real estate investment trusts could be life-changing for long-term oriented investors. The valuations are today at the lowest point in 10 years, and I expect the future returns to be exceptionally strong. Hey everyone, this is Yossi. I'm a CFA charter holder but not a financial advisor, so make sure to do your own research. I've run a small investment firm that specializes in REIT investing, and in today's video I'm going to explain to you why I believe that now is an exceptionally good time to get into REITs. But before I get into it, could you please do me a huge favor and click the like button? That really helped me a lot to grow this channel. Thank you so much in advance. So let's first back up a bit and study the historical results of REITs. Historically, they've been some of the most rewarding investments in the entire capital market, outperforming even the S&P 500 and growth stocks. On average, they've earned about 15% average annual total returns over the past 20-year period, ending with the crash of the pandemic. And seeing this chart on the screen right now, I'm sure that a lot of you are going to be surprised because REITs are often miscategorized as boring retirement stocks. How come were they so rewarding? Well, there are three reasons for it. For one, REITs earn significant cash flow from their properties. Investors will often look at the relatively low dividend yields of REITs and get misled into thinking that REITs aren't yielding much, but in reality the yield is so low because REITs retain a lot of cash flow to reinvest in growth. As such, the dividend yield may be around 5%, but the real cash flow yield that the REIT is earning may be closer to 8 to 10%. So with this yield alone, without any growth, REITs can already generate very attractive total returns. But then secondly, on top of this yield, the properties owned by REITs have been able to grow their cash flow and have gained significant value over the past decades. If a REIT is earning an 8% cash flow yield and on top of that its rents grow organically by 4% per year, that gets you to 12% average annual total returns without even accounting for the impact of leverage. And then thirdly, still on top of this yield and this organic growth, some REITs like Realty Income were also able to grow externally by raising more capital in the equity market and reinvesting it at a positive spread into more properties. And so that's how REITs like Realty Income have been able to generate 15% average annual total returns over the past decades. And I would add here that this is the average performance of the REIT sector. It includes the good, the bad, and the average. And so it also means that if you're able to sort out the good from the bad, you could have improved your returns materially. Just to prove my point here, just consider that self-storage REITs as a group have earned 18.8% average annual returns over the past 28 years. This means that $100,000 invested in self-storage REITs 28 years ago would have turned into over $12 million today. You would probably agree with me that this is life-changing money, and let's take it now one step further. Historically, REITs have been particularly rewarding in the time periods following market crashes when they were heavily discounting relative to their net asset values. A recent study by the investment firm Janus & Henderson found that REITs generated a 130% total return in the 3 years after they had been priced at a 24% discount on average. Today, we estimate that REITs are priced at a 25 to 30% discount on average, so future returns could be even greater than that. If this seems unlikely to you, then you probably should consider that REITs were even more rewarding than that following the last two crashes. In the years following the Great Financial Crisis, REITs nearly tripled in value in just 2 years. And following the crash of the pandemic, REITs more than doubled in just over 1 year. Today, the valuations of REITs are back to the lows experienced during the pandemic. Their share prices have dropped by about 30% on average, even as their cash flow grew by 5 to 10% over the same time period, and as a result, many REITs are priced at historically low cash flow multiples, high dividend yields, and large discounts to the net asset values. Moreover, I would add that their performance leading up to the recent peak had actually been well below average, and their valuation multiples were in line with historical averages if you adjust for their now stronger balance sheets and higher exposure to faster growing property sectors. Therefore, this recent crash wasn't just a reversion to the mean or a bubble that was popping. On the contrary, REIT valuations were and still are very strong, and I think that valuations even at the previous peak were quite reasonable in most cases. So why did REITs crash by this much then? I think that what happened is that when interest rates were really low in recent years, a lot of cash flow went from fixed income to REITs in search for yield. But these investors were not really interested in holding REITs for the long run, and so as soon as they could get a decent interest rate from fixed income, they sold their REITs irrespective of their fundamentals and shifted back to bonds. This is really what caused REITs to crash, and the proof of this is that the allocations to the REIT sector are today at the lowest level since the great financial crisis. But I think that this is a historic opportunity because this trend is now about to reverse. Most major banks, including the Bank of America, Morgan Stanley, UBS, Deutsche Bank, and others, are now expecting significant rate cuts by mid-2024. Therefore, the 5% yield that you think you're earning on your money market fund may turn out to be just an illusion, and as soon as investors realize that, I expect a lot of capital to shift right back into the REIT market. In that scenario, a lot of REITs could rise by 50 to 100% as they get closer to our fair value targets, and while you wait, you also earn a 6 to 8% dividend yield, and a lot of these REITs are also able to grow by about 5% per year. And when you add all of this together, I think that a lot of REITs today are presenting an opportunity to earn 15 to 20% average annual total returns over the next 10 years as they recover from the recent crash. And so if you now invest $100,000 into REITs and you expect it to compound by 16% per year over the next 10 years, that would turn into nearly $500,000, which is life-changing money. This is why I'm investing most of my savings into REITs at the moment, because I think that this window of opportunity won't last much longer and I want to make the most out of it. Now, if you want to access my entire real money REIT portfolio, feel free to join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it in the description of this video. And otherwise, once more, if you could please click the like button, that will really help me a lot to grow this channel. Thank you so much for all your support, and see you at my next one. Bye bye.